Welcome to This Explainer. Look, tax season absolutely does not have to be a season of dread. Today, we're breaking down the 10 most common tax pitfalls people face, and way more importantly, we're giving you actionable tips to protect your wallet in 2026. Whether you're an employee, a freelancer, an active investor, or a small business owner, the stuff we're covering today directly impacts your bottom line. Ever sit down to file and just wonder why some folks end up paying thousands more in taxes than they really should? Or why they suddenly get one of those heart-stopping, totally unexpected notices from the IRS in the mail? It's a massive source of anxiety, right? We all worry about leaving our hard-earned money on the table, or worse, making some tiny misstep that triggers an audit. But here's the truth, and it's actually pretty reassuring. When those IRS notices show up, or when people overpay, it's almost never because someone committed intentional fraud. It's just because they made simple, completely avoidable mistakes. It's about a lack of organization, not a lack of honesty. By the end of this explainer, you're going to be fully equipped to sidestep these landmines completely. To keep things super simple, we've organized these mistakes into 4 key areas: organization and deadlines, tracking hidden income, deductions and payments, and the final review. Let's jump right into part 1, organization and deadlines. This is all about getting your foundation set. The very first, and frankly, one of the most expensive mistakes you can make is blowing past the tax filing deadline. Gathering your records really needs to start early, like January 1st early, well before that traditional April 15th deadline. If you owe taxes and you miss that date, the stakes are incredibly high. The IRS can, and absolutely will, charge both failure to file penalties and interest. And here's the kicker. Those penalties just keep snowballing until the balance is fully paid. You want to avoid that at all costs. Now, here's a really crucial distinction. If you're running behind, you absolutely should file for an extension. But you have to remember this golden rule. An extension gives you more time to file your paperwork. It does not give you more time to pay the taxes you owe. If you file an extension but wait until October to actually pay your bill, you're going to get hit with surprise late payment penalties. Estimate what you owe and pay it by the April deadline, even if the final paperwork comes later. Think you can just swipe your personal credit card for a quick business expense? Actually, scratch that. Please don't do that. For freelancers and business owners, mixing personal and business expenses creates absolute chaos. It's super tempting to just use one account for everything. But if you do that and you ever get audited, it becomes almost impossible to definitively prove which expenses were actually for the business. The best practice? Always maintain separate business bank accounts and keep those records organized year-round. Just don't commingle your funds. Moving right along to part 2, tracking hidden income. We're looking at the money flowing into your accounts. Mistake number 2 on our list is reporting incorrect income. And usually, this is just a simple sin of omission. Tons of taxpayers simply forget about side income. Did you do a little freelance work? Maybe pick up some gig economy shifts, sell some things online? Or what about investment income and interest from your savings accounts? These are all very real streams of income that taxpayers frequently and entirely accidentally leave right off their returns. Well, here's the funny thing about forgetting that side hustle. The IRS already knows. They get copies of your forms, like your W-2s and 1099s. If you took on gig work, the paper trail is already there. If the tax return you filed doesn't perfectly match the records the IRS has sitting in their database for you, their computers will automatically flag it. You'll get a notice, and you'll likely owe additional tax, plus interest and penalties. The fix is simple. Gather every single tax document before you even start filing. Let's talk about investments for a second, because a huge mistake people make is forgetting about investment taxes. Selling stocks, ETFs, or crypto can trigger taxable gains. There's this really common myth out there that taxes only kick in when you physically withdraw cash from your brokerage account and move it to your checking account. That's entirely false. A taxable event happens the precise moment you sell an investment. Even if you turn around and immediately reinvest that money into a totally different stock within the exact same account, you still triggered a taxable event on that first sale. So review those transactions carefully. Which brings us to a really nasty double whammy, taking retirement money out way too early. Withdrawing these funds is exceptionally expensive because, well, you get hit twice. Depending on your situation, you're going to owe regular income tax on the amount you withdraw, plus a second massive penalty, the early withdrawal penalty. While there are a few very rare exceptions, most taxpayers are completely shocked when they see the final bill. Always make sure you understand the consequences before you even think about touching those retirement funds. All right, Section 3, deductions and payments. We've talked about the money coming in, so let's handle the money going out. This is an absolutely crucial point. You have to understand the difference between tax deductions and tax credits. Overlooking tax credits is a mistake that quite literally costs people thousands. You see, most folks fixate on deductions. But unlike deductions, which just lower your taxable income, tax credits directly reduce the actual amount of tax you owe, dollar for dollar. We're talking about the child tax credit, education credits, energy credits, and the retirement savings contributions credit. Missing just one of these doesn't just mean a slightly higher tax bill. It means leaving hundreds or even thousands of dollars right there on the table. But what about those deductions? Well, a tax deduction is only as good as your records. Claiming deductions without documentation is a critical error. Whether you're claiming charitable donations, business expenses, or a home office deduction, you've got to have the proof to back it up. Keep your receipts, your bank statements, detailed mileage logs, and official donation acknowledgments. Because if you can't produce these during an audit, the IRS will simply toss the deduction out and your tax bill is going to skyrocket. Good record keeping isn't just about being neat, it is extremely profitable. Here's another massive payment mistake: ignoring estimated tax payments. If you're self-employed, a freelancer, or bringing in substantial investment income, you can't just wait until April to settle your tab. You're required to make quarterly estimated tax payments throughout the whole year. A lot of people wait until tax season to pay everything in one giant lump sum. But unfortunately, the IRS might hit you with underpayment penalties for missing those quarterly deadlines, even if you pay the full amount you owe when you finally file. So calculate what you owe throughout the year and make those payments quarterly. We've reached our final phase, Part 4, the final review. This is where we turn a stressful, rushed submission into a calm, procedural victory. You would be amazed at how many people fail simply because they didn't update their personal information. Did you move recently? Did your name change after getting married? Is there a typo in your social security number? Just failing to update these incredibly basic details can completely derail your tax processing. It triggers unnecessary IRS correspondence and can hold up your refund for weeks or sometimes months. Also, definitely triple check your direct deposit routing and account numbers. 5 minutes of careful review here literally prevents weeks of absolute frustration. The overarching mistake here is filing without truly reviewing your return. People get to the very end, they're exhausted, and they just rush to click submit. Don't do it. Just follow this simple 3-step checklist. Step 1, check all that personal info we just talked about. Step 2, review the math. Make sure you haven't accidentally clicked the wrong filing status, and ensure no forms got left behind. Step 3, verify your signatures. Better yet, just use the final review features built into your tax software to catch these easy, silly mistakes. And hey, if your return is complicated, absolutely have a qualified tax professional review it. As we bring this explainer together, I really want you to take away one core concept. Avoiding IRS notices and protecting your money isn't about getting lucky. It's about organized financial hygiene. Almost all IRS tax mistakes are completely preventable with just a little bit of planning, organized records, and a careful final review. Being proactive is exactly what saves you hundreds or thousands of dollars while practically eliminating your risk of audits and notices. I want to leave you with a quick thought to provoke some immediate action. Look around at your own desk, your computer folders, or that shoebox full of receipts right now. Ask yourself honestly, are your records genuinely ready for 2026? Take the time today to build that solid foundation so when tax season rolls around, you're fully prepared to keep every single dollar that rightfully belongs to you. Thanks so much for joining me on this explainer, and I can't wait to help you master more topics soon.